Insurance for our essential infrastructure is becoming more expensive. The premiums for covering the roads, bridges, power grids, and water systems that form the backbone of modern society are on a steady and sometimes sudden upward climb. This essay will explain the mechanisms behind this trend. It will not focus on blame or political debate. Instead, it will use a systems thinking approach to reveal the interconnected causes and effects. We will look at how the individual actions of different groups, when combined, create feedback loops that can lock the entire system into a state of rising prices and increasing vulnerability. The story begins by understanding a simple yet powerful mechanism. The core function of insurance is straightforward. An infrastructure owner, such as a city or a utility company, pays a regular premium to an insurer. In exchange, the insurer promises to pay for repairs or replacement if that infrastructure is damaged by a covered event, like a storm or an earthquake. When the total cost of these payouts, known as losses, begins to rise across the board, insurers must adjust their pricing to remain solvent and profitable. They raise premiums to match the newly perceived level of risk. This is the most basic cause and effect relationship in the insurance market. However, the reasons why these losses are increasing are far from simple, involving environmental change, economic pressures, and human decisions. Understanding this price escalation requires us to look beyond the immediate transaction between an owner and an insurer. We must examine the entire system, including the global financial markets that backstop the insurers and the government bodies that regulate them. The delays inherent in this system are crucial. These delays mean that price adjustments are often not smooth and gradual. Instead, pressure can build up unseen within the system for years, only to be released in the form of abrupt and significant price hikes when a critical threshold is finally crossed. This essay will dissect the system into its component parts and the rules that govern their interactions. We will first introduce the main actors and their roles. Then, we will explore the surface-level causes of rising losses, such as increasing physical hazards and patterns of human development. Following that, we will dive deeper to uncover the hidden drivers, including the feedback loops and incentive structures that amplify costs. We will examine how these dynamics ripple through the system to affect project viability and public budgets. The goal is to provide a clear, evidence-first map of the problem, revealing how a series of rational individual decisions can lead to a challenging and costly collective outcome. To grasp why infrastructure insurance costs are rising, we must first identify the key players and their distinct roles. The first and most central actors are the infrastructure owners. Their primary goal is to provide reliable service while managing their budgets effectively. On the surface, the most apparent driver of rising insurance costs is the increasing frequency and intensity of physical hazards. Climate models in recent history show a clear trend of more extreme weather events. More powerful hurricanes make landfall. Wildfires burn larger areas with greater ferocity. Patterns of intense rainfall lead to more widespread inland flooding. These events directly damage infrastructure. Each of these incidents generates an insurance claim. As the number and size of these claims accumulates, they form the new baseline of historical loss data. That baseline compels insurers to update their risk models. There is a critical delay built into this process. Insurers are cautious and data-driven. They do not overhaul pricing after a single bad storm. They wait to confirm a new statistically significant trend. Once a threshold is crossed, for example, a third 500-year flood in a decade, the models are recalibrated. Recalibration can lead to a sudden, dramatic increase in premiums as price catches up to years of unpriced risk. Parallel to these physical hazards are human factors that amplify the financial consequences, development that increases exposure, and deferred maintenance that reduces resilience. Beneath the surface, causes of storms and aging bridges lie deeper, structural mechanisms of finance and regulation that powerfully influence insurance costs. The global reinsurance market acts as a financial shock absorber for the entire industry. When catastrophes occur, primary insurers pay claims, but large portions pass to reinsurers. Hurricanes in the Atlantic, typhoons in Asia, floods in Europe. Those events can significantly deplete reinsurers' capital reserves. Capital is global and fluid, so investors now see higher risk and demand higher returns. With less available capital, its price goes up. Primary insurers have little choice but to pay higher reinsurance costs, and they pass those increases directly onto infrastructure owners. Regulators mandate capital reserves relative to risk. After heavy losses, capital is reduced just as required capital may be raised, creating double pressure. To resolve this, a company can raise capital, expensive, or reduce exposure by halting new policies or non-renewing in high-risk areas. When multiple insurers act at once, the supply of insurance contracts rapidly contracts. This regulatory-driven market exit is a step change that causes abrupt, severe price shocks. The various parts of the infrastructure insurance system do not operate in isolation. They are connected by feedback loops that can reinforce and amplify initial trends. One of the most powerful is the premium investment loop. Rising losses lead to higher premiums. Budget-constrained owners defer non-critical maintenance to afford coverage. The now weaker asset is more likely to fail during the next event, generating larger claims and triggering further premium increases. A second loop involves market withdrawal and government intervention. As availability drops, pressure mounts for public pools or disaster relief, masking true risk prices. Masked prices can spur more development in vulnerable areas, increasing exposure. When large events hit, taxpayer-funded programs can become financially unsustainable. Rising insurance costs flip project ROIs and stall needed upgrades. Operating budgets cut maintenance first, increasing vulnerability, and, ultimately, costs. Where private insurance is unaffordable, some entities go bare, shifting risk to local taxpayers or federal aid. Uncertainty deters broader private investment. Over time, capital and opportunity migrate to safer, more insurable locations. The rising cost of insuring our essential infrastructure is not the result of a single failure, but the emergent property of a complex, interconnected system. It is driven by the collision of more energetic physical hazards with a landscape of increasing value and aging assets, amplified by global capital that moves to avoid risk, and by regulatory thresholds that enforce solvency. Delays and feedback loops create slow-building pressure punctuated by sudden price shocks. This is not a story of greedy insurers or irresponsible governments. Rational actors pursue logical incentives. Insurers protect solvency. Owners balance budgets. Regulators ensure claims can be paid, and the cycle reinforces. The system-wide effects are very clear. Stalled projects, decaying public works, and a fundamental shift of risk onto taxpayers. The final insight is that the trajectory is not fixed. Breaking the loop requires addressing root causes. Paths include public and private investment in resilience, regulatory approaches that reward risk reduction, and innovative instruments that bring new capital. Each path trades short-term cost for long-term stability. Better data, more forward-looking models, and a shared understanding of systemic connections are essential. The system is adaptive and will react to interventions. Given these reinforcing loops, where is the most effective point to intervene to create a more resilient and affordable future for our infrastructure? You've been watching System Atlas, exploring how the world's systems really work. Share your comments below. See you in our next episode.